Welcome back, everyone, to another FOMC preview. Tomorrow, we will be streaming live the Federal Reserve's release of their rate hike decision at 11 a.m. Pacific Standard Time, followed by the 11:30 a.m. Pacific Standard Time press conference by Jerome Powell, where he will give a statement and then he will be answering questions from the press. We will be watching it live starting at 10:30 a.m. Pacific time. Just make sure you're here by 11 because we have to go through the summary of economic projections, and that's going to be a really big deal. But before we talk about that, I thought you might find this particular chart quite interesting. Take a look on screen now. This right here is the downtrend that we have been sitting in for 2022. And it sucks because as the headline here speaks, shout out to Bloomberg for this, 2022 has meant lower highs and lower lows. And if you take a look closely, and especially kind of behind me there, you can see exactly that. We're in a solid downtrend, which is the opposite of what we had seen before that. Remember, in the earlier portion of 2020 and 2021, we literally had the opposite channel. In fact, if I hop on over to a Webull, we could see exactly that. That's right on screen here. You could see we had an up channel. Now we've transitioned to this nasty down channel. And so we're going through the poops. And this is where I have to make an argument that I got in a debate with somebody about on Twitter. I said that cash is probably the most important asset that you can have during an inflationary period of time like today. And they got mad at me. They said, how could you say that cash is good during inflationary times? And the argument is simple. If you are using your cash to buy groceries, gas, food, whatever, you're getting screwed. But if you are using your cash to buy assets like stocks and real estate, as stocks and real estate go down in value, your cash stays stable. So your cash is here and stocks and real estate are going down. That means you can actually buy more stocks and real estate with the cash you have. So if you have the liberty of having cash to invest because either you're wealthier or you're organizing a fund, like for example HouseHack, which is my real estate fund for the company we're launching, househack.com. Go there, learn a lot more. We're accepting accredited investors. We've got a big deadline coming up on September 30th, so check that out. But we've already raised over $15 million. It's really incredible. But anyway, so the more cash we have and the cheaper houses get, the more houses we can buy. So anybody who says cash is trash during an inflationary recession should always follow up with, for what? Cash is trash if you're trying to buy a used car or natural gas or earlier this year, or wheat or lumber last year, right? Now, cash is actually great. Cash is king, baby. Bottom of the market, cash is king. Cash is how you make money. So you got to get as much cash as you can together. Either your own cash by working harder to make more money, paying off debt and having more free cash flow, or the bank's money by refinancing your properties, by taking out home equity lines of credit, whatever you got to do to have cash ready. Now, you only want to take out debt if you can actually afford that payment. You don't want to be, somebody who takes out a bunch of debt and then goes bankrupt because you can't afford the payment. So job stability is really important. But this is something very important to know about when we talk about cash is trash. It's not true. Cash is king at the bottom of the market, baby. I promise you it is king. And that's why we're raising as much as we possibly can with HouseHack, because I think we can do some substantial catapulting in the valuation. No guarantees, obviously, at HouseHack, though, for investors when we go buy right at the bottom of the market. It's going to be great. So the first thing that we've got to talk about now beyond sort of this downtrend that we're in and cash is trash is we got to talk about the Fed. So obviously tomorrow is Fed rate hike day. The market is wildly, or I should say, well, it is pretty wild, but I should say widely, widely anticipating that we will be getting a 75 basis point hike. These are the current markets that show you the odds here. You can see the white line shows you the odds of a 75 basis point hike. And the line that we have below that, that blue line that I'm somewhat covering over here, which I'll show you, these are the odds of a 100 basis point hike. You can see they don't actually add to 100%. That's because when the market closes, you kind of get this weird gap up and rounding over here. But generally, we see this as about an 81 to 19% chance. So right now we're sitting at roughly an 81% chance that we're going to get a 75 basis point hike, and we're sitting at about a 19 to basically 0% chance that we're going to get a 100 basis point hike. There's a lot of argument that a 100 basis point hike, or a full 1%, right, which equals 1%, a full 1% would bestow upon the Fed some credibility that apparently and allegedly they need because they were behind on inflation. And to some degree, I'm not here to like shill the Fed to defend them, but to some degree, like, they made the right choices. I mean, they overstimulated certainly during the first COVID rounds, but they couldn't have predicted Delta, Omicron, and war altogether. And again, so not saying they shouldn't have responded even sooner once those things happened. Even after the war, we were still easing, which that was insane. Like, there were certainly micro decisions that were wrong, but I mean, they had a lot thrown at them. Again, not making excuses for them. The thing is, a lot of the market thinks they have to restore some of their credibility, and maybe by doing a 100 basis point hike, they would be doing exactly that. However, I do believe that if the Fed decided to go for a 100 basis point hike, they would certainly shock the market. I expectedly have quite a red day tomorrow in the stock market if we got a 100 basis point hike. And I don't believe it's the Fed's intention to shock the market, since I do believe that the Federal Reserve believes what Robert Shiller says, that a larger portion of the wealth effect actually comes from real estate and not stocks. And fortunately, because the Fed in that direction is coming out and is suggesting that rates are going to stay higher for longer, we're actually anticipating that the Federal Reserve will be pushing up and driving up Treasury yields, which drive up mortgage yields. The 10-year Treasury today is sitting somewhere around 3.5%, which is quite remarkable. It's actually almost at 3.55%. The 2-year yield right now is at a 15-year high. Also quite substantially remarkable. If we take a look on screen right here, you can see the 10-year Treasury as listed here on CNBC.com. That's 3.55%. Quite remarkable. Makes real estate very, very expensive. Creates a lot of damage in the real estate market. This is the damage in the real estate market that at House Hack we want to capitalize on. Obviously, we're building the war chest and building the systems and building the teams, so that way we can swoop in with cash at the bottom of the market. Okay, so inflation right now, I don't think is the big thing that everybody is fearing in the market. I think the fear is that the Fed is torn between this. Do we rebuild credibility with like a Volcker-style hike or larger hike, because 1% isn't really that great, but I mean, not that large. It could be larger, right? But it's a lot, especially if you get a series of 1% hikes, you start turning into Volcker. I think the biggest fear for tomorrow isn't, though, inflation or 75 or 100. It's what the summary of economic projections is going to say. The summary of economic projections is probably the most critical document that everybody is going to be talking about tomorrow. And it is going to be quite eye-opening to see how the Federal Reserve's opinion has changed since their last summary of economic projections, which we last got in June. I was on a boat in Canada reviewing the last summary of economic projections. Leave a comment if you were there for that. So take a look at the summary of economic projections that we had from June. Those are up on screen right now. And what we can see here is in June, we had an expectation from the Federal Reserve that we were going to see GDP at the end of 2022 sitting around 1.7. Inflation, according to PCE, would be somewhere around 5.2. And we would end up seeing the Fed funds rate end at about 3.4 towards the end of the year. I'm going to go ahead and write my estimates here, and these are just my guesstimates, okay? They're not really guided by anything other than me. So my belief is that we're probably going to have a projected Fed funds rate here of somewhere around towards the end of the year, that is. Probably, I wouldn't be surprised if they end up saying 3.8, but potentially 3.9. And then for next year, for 2023, I would guess this is going to sit somewhere around 4.4 to 4.6. So these are going to be Kevin's estimates. Okay, then I do expect that for 2024, the Fed would show some kind of softening, kind of like they did here, where you got this up and then down again, right? So it wouldn't surprise me to see this maybe back to like 3.9 or something like that. That's roughly an estimate that I would give right now. If we look at the unemployment rate, I really think this is going to be an area where the Federal Reserve is going to have to show an increase in the unemployment rate. And so I would anticipate that the Fed is going to show us some kind of unemployment rate increase in 2023 and 2024, probably up to something like 5%. But realistically, it wouldn't be surprised if it ends up coming in like a 4.7 to 4.9, something like that. And the reason for that is, I hate to say it, and it's a little bit cynical, but is somewhat political, right? There is a political impact that the Fed is going to be creating via these forecasts and estimates. It'll be very interesting to see where these numbers go, though, the change in real GDP. And something that's really incredible tomorrow is we're actually going to also get 2025 numbers, or at least we are expecting it to get 2025 numbers. So we should actually have 4 columns here and then the longer run. So, I don't know that we really need to project into 2025, but we'll be able to see what the Fed is thinking about this tomorrow. So I would say the most important, most critical items are going to be the certainly, like, number one, hands down, is going to be the Federal Reserve's projected Fed funds rate, right? So this is by far going to be the top priority. This is going to move the markets right here. If this number comes in higher than like this 3.8, 3.9, you're getting a big fat red day tomorrow. If it comes in here slightly below at expectations, big deal. Wouldn't be surprised to see a rally actually after the Fed meeting. That has happened probably, I would say maybe 5 out of the last 6 meetings. Just spitballing here, I would say we've had green days following the Fed meetings. Like, investing on Fed meeting morning, it was usually has consistently been a pretty decent bet. But I mean, if we get some kind of shocker here and some kind of realism, great. But then again, remember when I was on that boat in Canada, I'm like, hey, Fed, I tell me in the comments if you remember this. But when I was on that boat in Canada, I'm like, we need the Fed to just give it to us. Just give it to us dirty already. Just tell us the truth for once, right? That's what I said back in June. And we never really got that from the Fed. In fact, I remember looking at the SEP and I'm like, really? This isn't even realistic the way you did it. It's kind of, in my opinion, a joke. I remember saying that afterwards because I'm like, dude, this was the Fed's chance to just be real with us, and they weren't real with us. So what happened the next month? Because they weren't real with us in June, we get slapped in the face with some of the worst inflationary readings month over month. Not necessarily that those two are definitely correlated, but it's just the Fed certainly didn't put the fear of God in us because, we actually had a nice market recovery from June all the way through the middle of August. We've given a good amount of that back, but, Anyway, now, the third thing that we need to talk about is inertial inflation. Look, in case you're not familiar with this yet, when interest rates go up, it becomes very difficult to purchase a home because mortgage rates are sitting at 6.5% to 7%. This is insane. This is why when we go buy houses, and again, if you're an accredited investor, I encourage you to join me at househack.com. You can upload your W-2s or your tax returns or get a letter from investready.com and you can invest with me. But at HouseHack, I think we're going to be looking at once in a generation opportunity to buy really, really good deals in real estate. And you're getting in with founder shares. And one of the cool things about inertial inflation is as these mortgage rates go up to 6.5% to 7%, we're actually going to be in a situation where, oh crap, purchasing power is going to get eradicated for home buyers. And really, unless you have cash to buy real estate, you're not going to be in a great position. The good news is we're going to deploy the cash that we have probably in the middle to end of 2023, 2024 to go buy real estate. And then we'll refinance a few years after that. And that's really because we believe we'll probably have peak fear in real estate pricing towards next year and the end of next year. And then, of course, 2024. Problem with that is when you have pain in real estate pricing, you actually have about a 6-month lag due to inertial inflation in rents actually going down. And that's because as real estate pricing gets whacked via higher mortgage rates, more people choose to rent rather than buy. That creates more demand for renting when we already have a national shortage of homes. And so rents actually get driven up. This creates more inflationary pressure on rent. It's actually beautiful for investors of real estate because you're getting more rent and lower priced real estate, but it sucks for anybody renting. It just is what it is. I hate to be the bearer of bad news. Now, there is some little semblance of hope here, though, that maybe finally we're starting to see rents chillax a little bit. Maybe finally, okay? That's not great. But we are starting to see, at least according to data that came out from CoreLogic today, we are starting to see rents finally begin to cool. Finally, it's taken quite a while to actually see rents cool, and here they are, folks. Rents are finally beginning to cool. You can see the single-family rent index here year over year. When you look at year-over-year numbers, it's really important to understand how these work. These numbers are numbers that tell you, looking back all the way to last year, we're up 12%, right? Or we're up 14%. And in various different markets, these different lines, we're actually seeing the inflection, right? An inflection point is when everything was going one way and now it's going the other way. This is where you get some people who are uneducated in finance who say things like, what do you mean rents are going down? They're still up 12% year over year. Yes, they are. But they're now trending down. The trend has changed directions. It's really important, okay? And so we want to watch this trend continue to change. Unfortunately, though, it's going to take until this number goes all the way down over here under the 2% number, essentially. We have to get all the way down over to this region here where rents really aren't going up. Whoops, lost the connection on that one. Where rents aren't really going up for us to actually see that inertial inflation go in the opposite direction. Now we're looking forward to that. But unfortunately, rents take a while. They're very, very slow to adjust. Part of that is honestly because of the way the Bureau of Labor Statistics collects this sort of data. It's miserable and it's antiquated. There's this system called owner's equivalent rents, and it's historically about 6 months delayed. It's a super lagging indicator of inflation. It just happens to be that we use a super lagging indicator of inflation to help determine how high inflation is at the moment. And unfortunately, the Federal Reserve raises rates based on this really antiquated measure, basically. And that's really dumb, but it's what they do. So just because it's dumb doesn't mean it's a good idea, but it does it. By the way, I keep getting these Be Real notifications. I signed up for it. If you want to follow me on there, I think I'm Real Meet Kevin. I think I'm probably going to start posting there tomorrow. I've never really tried it. Let me see. Oh, no, I think I got Meet Kevin. Oh, I got Meet Kevin. Oh, yeah. BERE.AL/Meet Kevin. That's pretty dope. Anyway, you're welcome to follow me there. I've only posted one picture so far on the 11th. Your memories. How do I just want to make that visible. Anyway, so yeah, I feel free to add me on there. I don't know. I don't know if I will post it, but I think I want to give it a try. Okay, so that tells us a little bit about rents. Now, the next thing that we need to talk about is Treasury yields, folks, and the bond market. The bond market is seeing some substantial stress, okay? Now, this gets a little granular, so I'm going to keep this a little simple, okay? Because, even I start getting a little bored of this kind of stuff, but I just want to give you some warning signs here, okay? We are seeing stress in the bond market. So corporate borrowing rates and the spreads, they're called yield spreads. How much above the Treasury yields are like high-grade corporations having to pay for debt. And basically, as this line goes up, even high-grade corporations are having to pay more money to borrow money. It's not ideal. That restrains their opportunity to invest. It makes it more expensive for them to borrow. You have substantially higher default rates coming up on LIBOR related borrowings. A lot of these have to do with more like junk bond style companies or more potentially distressed companies. We're jumping up to levels that we haven't really seen since 2008. You've got liquidity plummeting in the Treasury market. Now, this chart is really complicated. It's a measure of errors in the spreads when they actually conduct these bond auctions. And the higher it goes, the less liquidity there was to give a more accurate set of pricing. Basically, bottom line is, who remembers right here when I went on the Jordan Belfort podcast? When I went on the Jordan Belfort podcast, we had a massive liquidity. Why is this HDMI keep dying? Anyway, we had this massive crisis in terms of liquidity in the market. All of a sudden, nobody was buying these treasuries. And so we had this massive spike there at the end of 2019. And we're kind of at those levels like consistently now, which is quite remarkable, that we're rising to levels that then were considered panic. And now it's just like normal. So yeah, not great. Worsening bond market liquidity, also not great. And then, here we go. Also seeing costs of credit default swaps and any kind of protection against default from companies rising. So in other words, the white line is a sign that things are getting more expensive to insure against. It's basically more expensive to get insurance against default in the bond market. Of course, then obviously we also have international risks going on. I mean, look at the strength of the dollar versus the euro, for example, has been remarkable. I ended up shorting the dollar roughly around this level right around here, and it's kind of been bobbing around there because I'm like, it can't last forever. But boy, oh boy, the dollar has been really, really strong. I shorted the dollar right at about $1 equals €1, and that's roughly where we sit right now. And that has, it did well for the first month, but now it's back to that same level where it was. And I'm like, wow. I mean, at some point the dollar is going to fall, but it's doing very well because the United States economy is doing so well. It's so strong. And this is what's very interesting, is that you've even got the CEOs of JP Morgan Chase, and they're talking up the story of the tale of two cities. It's the poor, and I've been talking about this for 2 years. Poorer individuals are getting screwed by inflation and higher costs. Sure, their wages are going up higher than even higher income earners. That is, lower wage workers are making more money than they had been previously. And as a percentage-wise, their wages are growing faster than higher earners. But costs have just risen so much. So that does make it a lot harder. We're seeing less people able to afford their electricity bill, which is really sad. That my heart goes out to anybody in that situation. But I mean, there's a financial problem there. That's really, really bad. But we're seeing more people. I think 20 million households now unable to pay their electricity. It's quite remarkable. And then, you've got the CEO of JP Morgan Chase going on to suggest that, hey, but you know what? The higher income individuals are seeing larger balances in their bank accounts and much more strength than we've seen at any time in the past. So you really do have this really bizarre sort of recession that we're in. I'm willing to say we're in a recession. And tomorrow's summary of economic projections should give us some dramatic insight into what is the Federal Reserve actually think is going to happen. Again, that summary of economic projections is going to be everything. This is going to be critical for us with my projections written down here. Again, the most important being the Fed funds rate, followed probably by expectations for the unemployment rate. Then I would say the change in GDP, and then their expectations on inflation. I'm not too terribly worried about their expectations on inflation relative to these other things, because inflation is going to be what it is. However, I want to see how much are they okay with how high of an unemployment rate? How much are they okay with us potentially being at a negative GDP growth rate? The Atlanta Fed just released that we're probably only at about a 3% growth rate right now in quarter 3. And if I said 3%, I want to clarify, I meant 0.3%. And that's pretty miserable. 0.3% is terrible. I mean, we can look at it together here. But again, you got the Treasury yields here. We've got the oil markets sitting at $84 and $90. I mean, WTI, that's Western crude, and international crude, substantially lower from where we've seen in the past. If we just do a quick little look at what's going on in Asian markets ahead of the Fed meeting, we can see the Nikkei 225. This is your Tokyo Stock Exchange, down about 1.34% on one of their main indices. And if we look at the Bloomberg S&P to basically the Asian index, we see that sitting down about 1.44%. So we're seeing some pain in Chinese markets ahead of this Federal Reserve meeting. And let's see, what I forgot. I was going to look at something and I totally forgot what that is. So let me go ahead and do a little bit of Q&A and interaction here with those of you who are members of the channel here. Keep in mind that on September 30th, we are expiring the coupon code SEED for the programs on Building Your Wealth. With those, I go live generally every morning. The market is open. Sometimes it's a little tougher when I'm traveling, but I go live generally every morning. The market is open, and we do fundamental analysis, whether it's on real estate or stocks. We read earnings calls, earnings reports. It's really fun during earnings season because, honestly, most people never actually look at financial statements. And the cool thing is, if you join me, you get to see me do it. I've just passed my test to become a financial advisor. We'll have a financial advisory firm probably within 3 or 4 weeks here. So we got a lot of cool, exciting things coming up. And that's obviously separate from househack.com. Okay, so let's go ahead and answer some questions. Aren't you worried since high rates since rates are high, and once you buy a property, that you have to rent out properties so high that you can't find tenants to afford high rent. Okay, so Hector is asking, hey, if you buy real estate right now, like, aren't you worried that, like, if rates are so high, you're gonna have such a punitively high break-even cost? And the answer to that is no. I'm actually not worried at all, because we're going to buy properties cash with House Hack. We're not going to finance the properties. See, like, we are not creating a company that's like, let's sell a new pencil. And hey, Shark Tank, invest in this new pencil. We don't know if anybody's going to buy this stupid pencil, but we do know that people are going to rent properties and people are going to Airbnb properties. So we think there's actually very, very little risk. But of course, there's always the ultimate risk that it all fails. Why did you stop doing whiteboard videos? Oh, the blackboard. So those will be coming back. There's actually construction going on in that studio, and that construction finishes tomorrow morning. And then I can get back to actually putting it back together. There are some kinks I have to work out. I would imagine by Monday I'll be back and able to make Blackboard videos. Is Redfin a good purchase down here? So I'm not a big fan of actually any of the real estate companies right now, because I think they have a lot of assets on the book or on their books with Q1 valuations and even part of Q2 valuations. And I think those need to be discounted by about 10 to 20%. Once those property values are discounted by about 10 to 20%, because I think the real estate market will potentially fall by 10 to 20%, that's when I think it'll be very prudent to potentially look at those real estate companies for a turnaround. Keep in mind, if you want to learn everything that I know, and you don't want to invest with House Hack, or you're not accredited yet and you can't invest with House Hack, you can just download my brain on how to do this stuff. Like, there are plenty of deals for everyone. If someone's flipping in your market, you could do what House Hack is going to do. You could do what I would do. We don't flip. We take the deals from the flippers, like we buy the flipper, or we buy properties that flippers would love to buy, and we buy it out from under them basically before they can get their hands on them, and we rent them out. And so we make money over the longer term doing that. So I'm looking at Bitcoin like the canary in the coal mine. Yeah, you could do that. Historically, Bitcoin has moved before Fed meetings. It looks like right now BTC is sitting at essentially 19,000. It's been bobbing around just below 19,000 for much of the day today. How could we forget when you go on vacation? Those were the big dips. Yeah, that is true. Let's see. Bumpy market till the Fed pivots? No doubt. If they raise 0.75, will the 10-year yield go up or down? I would guess that the yield should actually go down a little bit. Not much, but I do think that the yield will go down because, it's going to depend on the SEP. But just from the rate hike, if they do 75, at least that's going to take some pressure off the markets. That 19% chance of 100 will be priced out then, and you should see yields fall. But if there's something scary in the SEP, the market's just going to drop. Like bonds and equities will fall, Treasury yields will go up. Travel is going to be great this holiday season. That's true. The dollar is so strong. Very, very true. Maybe an opportunity to buy the airlines. Ooh, I really dislike the airlines, but you know what? It's an interesting thesis. I'm already down. What percentage drop do you think the housing market will have in the next year, specifically the Midwest? I don't know anything about the Midwest, but I would say that nationally, we're probably looking at anywhere between 18 to 25% is my expectation. Is there a chance we can get some commission if we send you properties? Yeah, when House Hack starts soliciting deals, there will certainly be agents who get paid commissions for bringing us deals. I suspect there'll be some form of referral instruction or structure for people who send us deals who maybe aren't agents, and they're like, hey, this is a good deal. But we're not going to be buying all across the country. We're going to have very specific markets that we are experts in. Yeah, it's going to be single family and multifamily. It depends on the area in terms of which tends to be better. Recently purchased a vacation home with a variable rate mortgage. You think I should change this to fixed? I don't know how much it really, I don't know that I would really stress so much about it right now. There's a cap on how much your rate can go up. And the financing fees right now are extremely high. So, I can't give you financial advice and I can't give you a suggestion, but personally, I just probably wouldn't worry about it at this point, as long as you're comfortable with that payment in the event it becomes fully indexed, which means it goes to its cap. When student loans come back, do you expect SoFi skipping the earnings recession? I don't know. I think SoFi, like many brokerages, provides a lot of services that lose money. They have ETFs that are zero fee. They provide free financial advisory calls. I mean, I don't know if it's any good, but the brokerage, I'm sure, loses money. I think they make money on lending, but all the other channels that they have are just big money losers. And for me, I'm just like, I don't know, man. I don't feel comfortable with all these money losing businesses. Ooh, I like cash flow. That's what I like. That's why it's like when we go buy houses with House Hack, it's like, some of the haters, very few, but some haters are like, oh, it's going to go bankrupt. I'm like, dude, how? If somebody right now took $50 million and bought cash flowing real estate, how is it going to go bankrupt? Like, I don't know. I mean, I guess it's possible. You're right. You know what? Don't invest. It's like, whatever, man. It's just whatever. Like, it doesn't make sense to me, but some people are just haters. That's just whatever. So, okay, good. So, very important. There are that you come tomorrow for 10:30 a.m. I will be live streaming. 11 a.m. is the Fed meeting. At 11:30 is the Fed chair statement. And at 1:30, all times Pacific Standard Time, I will be interviewing Ross Gerber. Ross. So it'll be fun. Thank you so very much for being here. I appreciate your support. Check out the courses linked down below. If you're an accredited investor and you're considering investing and you have questions about House Hack, send us an email at ir@househack.com or message me in Discord in the channels by going to metkevin.com/chat. I did also pitch my Be Real in this. I meet Kevin on Be Real. And now that I've pitched it for the first time ever, I think I'm going to actually post there more than the one time I did.